You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo.
Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Tuesday. I'm recording this actually yesterday before the market opens, and the market looks ugly once again. Not a great start of the year, right? Ironically, we were supposed to have what we call the Santa rally, right? So there is a belief. I don't even know if it's true, but many times I think we see in December that the market tend to go up just because it's the holidays, people are happy, or like whatever reason. This year didn't happen, and it seems that it's a little bit rougher around the edges these days for our portfolios. That brings me to a question that I got, on YouTube. I did a video about my favorite stocks on the US side, and then another one that is coming up this week about the Canadian stocks. And I also had some discussion last week, on my podcast about my favorite stocks altogether. So on YouTube, I had a comment about what would be the point in investing in Alimentation Couche-Tard or the likes, where are they're growth stocks but very small dividend. The growth is not certain, so I don't see the point in investing in a stock that would not pay a decent dividend, and instead I'm going to go for the yield. So instead of going for the growth that is not certain, I'm going for the yield. That is the premise of a lot of investors, and I want to dig into that thought today. So first, that's an interesting point of view. Yes, you invest $100 on stock A, it pays not even $1 in dividend a year, and then you have the option of investing the same $100 in stock B, but paying a $5 dividend. It seems that it's a lot safer to go for the one that pays $5. On top of that, we have this premise that growth is not certain, and then that any growth stock could go down. So, first things first, I want to highlight this. A lot of investors confuse growth and stock price. What I mean by that is, for a company to grow, it means that the business is showing revenue growth. It increases its sales, and then it makes more profit. So it has pricing power, good margin. It's profitable. So you'll see earnings per share growing as well. So you can see I'm tying it up to the dividend triangle, the first two metrics. Revenue increases, profit increases. Technically, the stock price should increase, but I'm talking about growth here, not about the stock price. So when you're thinking about a growth stock, you're probably thinking, oh, this company stock price is going up by 20, 50, 100% over the past year. So that's kind of crazy, and that could go down anytime soon. There's nothing certain. I'll give you that. But the stock price, when it goes up or it goes down, it's a function of supply and demand, right? So if a lot of investors want to buy a stock, it's going to go up. If a lot of investors don't want to buy that stock and wants to sell it, it's going to go down. And that has sometimes a link to what's going on inside of the business, but sometimes it's just panic altogether. So short term, price fluctuation doesn't mean anything. Long term, it will be driven by metrics. It's almost impossible to find a company that increases its earnings for the next 10 years and see their stock price declining for those 10 years, right? If it's making always more profit per share, chances are it's going to work out. So when I talk about growth, I'm talking about a business increasing their sales and increasing their profit. So more revenue and more earnings per share. They have to go hand in hand to have a quality company. So when I talk about low yield, high growth stocks, I'm talking about a business that is, yes, offering a lower yield, but offers a lot of growth vectors showing year after year ability to increase their sales, increase their profit, likely increase their cash flow, right? Because that goes in and end. If you're making more profit and more sales, chances are your free cash flow and your cash flow from operation are going to be great. Well, do you want to have this kind of company in your portfolio or not? I'll let you decide. So going back to that question, is growth certain? Not at all. Is possible that a business that used to show a very strong dividend triangle fails at one point? Totally. And this is why it's important to monitor all your companies at all time, right? Every quarter, I monitor the results just to make sure that once the dividend triangle remain strong. So why not go for the yield instead, right? Because then we just established that the revenue growth and the earnings growth are not certain at all. So let's imagine like two potential investment. So imagine stock A, it's a pure growth play, not even paying a dividend. So stock A generates a lot of revenue growth, a lot of earnings growth for a while, and then eventually struggles. A lot of competition, not able to innovate anymore, name it. Sales are going down, so therefore profits are going down. So what's going to happen with this stock? Well, if the business is struggling and making less and less sales and losing, like not making any more profit and eventually losing money, well, the stock price will go down, right? So there you go. You should go for the yield, right? Well, now imagine stock B. Same thing, great company, but paying a 5% yield. But then imagine that this company is not able to grow at all. Same thing, like, growth is not certain. So if it's good for stock A, it has to be good for stock B. So stock B is in the same situation as stock A. Stock B is not able to grow their revenue. Their earnings starts to fall, and eventually they report losses on a quarter. What do you think is going to happen with that company? Well, exactly the same thing as stock A. The stock price is going to go down because investors will move their money away from a struggling company, which totally makes sense, right? Do you really want to buy struggling companies that are losing money? That's not the point of investing. So you're going to sell and you're going to move on. And what's going to happen with a business that is actually losing money this quarter and see no short-term possibility to increase their revenue and their earnings? Well, they will cut their dividend because there's no more money in their bank account. That's just normal, right? If you lose your job tomorrow morning, are you really going to spend $500 at the restaurant every other week? No, you're going to cut that expense because you just lost your job. That just doesn't make any sense to spend extra money. And for businesses, the dividend is an extra money. So then the other option would be, I'm going to go for the yield because when the market goes down quickly, like in a correction or a bear market, maybe that's going to happen in 2025, I'm going to have that buffer. So the market goes down 20%, but I have like a yield of 5, so I'm only down 15. Yeah, fair enough. But then again, you have to ask yourself why the market is going down. So of course, there's a little bit of panic. There's a little bit of like irrational, and that totally makes sense. So you don't have to worry too much about that. But there are also some real reasons. It's also based on facts. Usually weak economic environment. So a lot of people that are not working, so unemployment rate is going up. Consumers are not spending. Companies are laying off people. They're declaring like no growth. And what really happens during a weak economic environment? Well, the companies that are struggling, really, they're cutting their dividend because they're not making money and they see really tough time going ahead, and they want to make sure that they prepare a war chest and they have like more liquidity for the survival of the company. So instead of thinking about the survival of your retirement plan, they will think about the survival of their jobs and then of course of the business. So they will also cut the dividend. So going back to that point, is growth certain? Not, but the yield does not give you any guarantee whatsoever, because if it's true for pure growth stocks, it's also true for low yield, high growth companies, and it's also true for high yielding companies. In fact, when you look at high yielding companies, so companies offering a yield above 5%, well, you're going to find a lot of companies that have a very hard time showing revenue growth, earnings growth, or cash flow growth altogether. Most of them are stagnating or declining. So it's not a protection. It's just a reflection of the risk that you're taking when you buy a stock paying a 5%, 6% yield. You're actually getting rewarded by the dividend yield because of the risk you take. So there's not a free lunch here. And as growth is not certain, unfortunately, the dividend is equally not certain as growth. So if there's no growth, there's not going to be any dividend growth, and eventually it's going to be a dividend cut. So just think about that when you review your stocks, just understanding where the yield, where the stock price trends are coming from, why the market is going up, why the market is going down on a long-term basis. Of course, the next 2 weeks, whatever is going to happen on the market is going to happen on the market, not going to make a big difference, but for several years going ahead, that will have a huge impact. All right, Moose, that's enough for today. If you have done it yet, please go to dividendstocksrock.com/top stocks to download my small booklet of my favorite stocks for the year of 2025. You're going to find like 6 great ideas on Canadian and US sides. So it's dividendstocksrock.com/top stocks. You're going to have like a quick sector review plus the stock pick ideas accordingly. So, all right, Moose, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.